Good. Good morning. My name is Patrick Goodwin, and I'm an audit manager here at Rivero Gordimer and Company. I started here at RG&Co in 2016, and my primary focus areas are in the nonprofit and governmental industry, as well as clients in the rent-to-own industry. I'll be presenting along with Matt Saucier, who will be covering, and today we'll be covering an audit, review, and compilation overview, as well as how to produce audit-ready financial statements. So looking at the agenda for today's presentation, we're going to start with an overview of the three different types of attest engagements, which are audits, reviews, and compilations. For each engagement, I'm going to touch on what each of them are, what the process is of going through each engagement, and what to expect as a client, as well as when each engagement is necessary or required. Then we're going to transition to Matt, who's going to cover the steps to produce audit-ready financials and to make that process go as smoothly as possible. So, starting with the overview of the first attest service, what is a financial statement audit? So a financial statement audit is an independent examination of an entity's financial statements and related disclosures. The objective is to obtain reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error, and to issue an auditor's report that includes our opinion about whether your financial statements are fairly presented in all material respects, in conformity with accounting principles generally accepted in the United States of America, or US GAAP. As you can see in the slide, I've bolded and underlined a couple of key terms that I want to go over with you because I think it'll provide a little more context and clarity about the scope and objectives of an audit. The first term is reasonable assurance. And before I get into the definition of reasonable assurance, I just want to emphasize and stress the point that we as auditors are not providing absolute assurance. It's just not possible. We're not testing every account or every transaction, and there just isn't enough time or resources to provide that absolute assurance. But what is reasonable assurance? So reasonable assurance is defined as a high level of assurance, but is not absolute assurance, and therefore is not a guarantee that an audit conducted in accordance with generally accepted auditing standards will always detect a material misstatement when it exists. The next term I wanted to touch on is material misstatements. This is a key term because we're not stating that the financial statements are free from all misstatements, since we're not testing every transaction. We're stating that we're providing a reasonable assurance that the statements are free from material misstatements. So what makes a misstatement material? So misstatements are considered material if there's a substantial likelihood that individually or in the aggregate they would influence the judgment made by a reasonable user based on the financial statements. And why can't we detect every misstatement? We can't detect every misstatement because there are inherent limitations of an audit, as well as inherent limitations on an entity's internal controls. So because of this, there's an unavoidable risk that some material misstatements may not be detected by us, even though the audit is properly planned and performed in accordance with generally accepted auditing standards. Additionally, an audit isn't designed to detect immaterial misstatements, meaning that there could be small misstatements included in the financial statements, but those misstatements aren't large enough to influence the judgment of a user of the statements. Below, I've also included a list of some of the reasons why misstatements could exist in the financial statements. The first is fraud. So you could think of collusion, where you have two or more parties involved in defrauding an organization. The next is error. You can think of a bookkeeping error where an employee enters an amount incorrectly in the general ledger. Next, we have misappropriation of assets. This could be an employee stealing cash from a petty cash drawer. And lastly, we have violations of law or governmental regulations. So now that we've gone over the objective of a financial statement audit, next I wanted to go over the audit process from the beginning planning stages to the end where we send the client our audit report, just to give you an idea of the amount of work and detail that goes into an audit. So an audit is the highest level of assurance that we provide, and because of that, there's a lot of planning and documentation that goes into our work papers. One of the first things we want to do when we're engaged to perform an audit is gain an understanding of the entity and its environment. So we're going to want to look at how is the entity structured? Is there a governing board or an audit committee? What does the entity do? How do they generate revenue? What are the risks related to how the entity is structured? For example, is there proper segregation of duties? Is there a risk of management override of controls? Or are there any external risk factors, such as the potential loss of grant funding? Next, we're going to want to look at the understanding of the entity's internal controls for all of their significant audit areas. We do this by looking at any policies and procedures the entity may have, discussing the internal control processes with the client, as well as performing walkthroughs of significant transaction cycles. So for example, we'll discuss the cash disbursement process with the client, then we'll select a disbursement made during the year and verify that all of the steps in that process are being followed and adhered to. So now that we have an understanding of the entity and we've gained an understanding of the entity's internal controls, next we're going to want to assess the risk of material misstatement for each significant audit area. This is a very important step in our audit process because it determines our audit approach. We'll perform basic procedures on areas we determine to have a lower risk of material misstatement. However, for areas that we deem to have a higher risk, we'll perform extended procedures to get more comfortable with that audit area. And this can vary from client to client. For a lot of clients, revenue recognition is going to be a higher risk area, but it really depends on how the entity is structured, what the line of business they're in, as well as a number of other factors. So once we perform our risk assessment, we'll develop our audit plan, which is tailored to those risks that we've identified. So as you can see, there's a lot of work that goes into the planning stage of the audit, and we haven't even begun the actual detail testing of the various audit areas. So the next step in the process is to actually perform the testing. This is where we come out and perform our test of controls to evaluate the effectiveness of the controls. We're also testing account balances at a more detailed level. We're requesting GL details, we're sending you selections, having you pull the invoices and whatever other documentation we need that's necessary for the audit. We're tracing payments and cash collections to bank statements, as well as a number of other things. This is the part of the audit process where we're interacting the most with the client. And once we perform our testing, we're going to evaluate the results and determine whether we have enough evidence to support the balance shown in the financial statements. Once we complete that, our process still isn't complete. Once we determine that we're comfortable with the numbers on the financial statements, we then perform our completion procedures and make sure we have a true understanding of what occurred during the year and that we've documented and disclosed everything necessary in our files. So once we get through field work, we get to the part that everyone really cares about, which is us issuing our opinion, which is included in our auditor's report. So there are 4 different types of opinions. The first one is an unmodified opinion, and this indicates that the financial statements present a true and fair value in all material respects of the company's financial position. This is the highest level of assurance that we can provide on the financial statements, and it's a clean opinion. Next, we have a qualified opinion, which indicates that except for specific issues, the financial statements present a true and fair view of the entity's financial position. So for example, if there was a departure from generally accepted accounting principles that management refused to adjust, and it only affected a couple of accounts, then a qualified opinion could be issued. Next, we have an adverse opinion, which indicates that the financial statements do not present a true and fair view and are materially misstated. An adverse opinion could be used if there were pervasive misstatements that had a widespread impact affecting multiple areas and multiple accounts in the financial statements. And lastly, we have a disclaimer of opinion. This is issued when the auditor is unable to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. So for example, this could be due to client-imposed restrictions, so restricting auditor access to certain records, documentation, or other information. So as you can see, there's a lot of work that goes into an audit, from the planning to the field work to the completion procedures. And because of this, audits are going to be the more expensive option because they provide the highest level of assurance. So when is an audit needed or required? Well, there are multiple reasons why an entity would decide to have an audit. For nonprofit organizations, the Florida statutes state that a charitable organization or sponsor that receives $1 million or more in annual contributions shall have their financial statements audited by an independent certified public accountant. Additional reasons why an entity may need an audit include if a nonprofit or governmental organization expends at least $750,000 in a fiscal year of grant funds, as well as if they expend $750,000 or more in state grant funds. Additionally, if nonprofit organizations, receive any type of grant funding, there's a likely chance that they will require an audit. It's really important that, if you do receive grant funds, that you read the contract to get an understanding of the financial reporting requirements. You want to make sure that if an audit is required, that you're meeting that requirement. Other reasons include if you receive a loan from a bank, depending on the dollar amount of that loan, it could trigger an audit. It also may be a regulatory requirement, or it could be requested by the board of directors as a best practice. So these are just some of the reasons why an audit may be required, but as I mentioned earlier, it's always important to read over any contracts or agreements you may have to determine if an audit is necessary. So now that we've covered audits, the next type of engagement is a review. When comparing audit and review engagements, one of the main differences is related to the objective. So if you remember, the objective of the audit was to obtain reasonable assurance, while with the review engagements, the objective is to obtain limited assurance. So review engagements are also substantially less in scope than an audit. An audit involves detailed testing of transactions, external confirmations of account balances, and assessing internal controls. A review, on the other hand, relies primarily on analytical procedures and inquiry of management. So we're not looking to gain an understanding of internal control. We're not assessing fraud risk or testing account records when it comes to a review engagement. So as I mentioned in the previous slide, review procedures rely primarily on analytics and inquiry of management. So we perform analytical procedures to identify relationships and trends and compare those analytics to our expectations that we've developed during the planning stages of the review. Examples of different types of analytical procedures include ratio analysis and trend analysis. And if the analytics performed fall outside of our expectation, then we're going to inquire with management about what might have occurred during the year. We'll also perform inquiries at the beginning of the review to help us set our expectations. So we'll inquire with management about any major sales or purchases, any new debt that they might have incurred during the year, any losses or acquisitions of new customers. Basically anything to help us gain a better understanding of what could have impacted the financial statements during the year. So looking at the review report, a big difference between a review report and an audit report is that an audit issues an opinion on the financial statements. So for example, an audit would state, In our opinion, the financial statements present fairly in all material respects the financial position of ABC client as of their year-end date. A review, on the other hand, issues a report stating that we are not aware of any material modifications that should be made to the financial statements in order for them to be in accordance with accounting principles generally accepted in the United States of America. So you can see the change in wording between an audit, which provides a reasonable assurance, and a review, which provides limited assurance. So when is a review necessary? So for the state statutes state that for a charitable organization or sponsor that receives at least $500,000 but less than $1 million in annual contributions, the financial statements shall be reviewed or audited by an independent certified public accountant. It also could be required by a bank or a lender, again, just depending on the amount of money that was lent. And as I mentioned when I was talking about audits, it's important to read any contracts or agreements you have to determine if you have a review requirement. This slide just lists out some of the benefits and limitations of reviews. So looking at the benefits, it's going to be more cost effective than an audit just because we're not doing as much detail work. And it does provide some level of assurance. Obviously not as much as an audit, but it does provide a moderate level of assurance. Additionally, it can help identify potential issues or areas of concern that may need to be addressed by management. Some limitations of review engagements include limited assurance, so a review doesn't provide the same level of assurance as an audit. There's no opinion, so we don't express an opinion on the financial statements with a review engagement, and scope limitations. So as I mentioned before, we're only performing analytics and inquiries without any detail testing, like in an audit. So the last type of accounting service I'll cover is compilation engagements. So the objective of a compilation is to assist management in presenting financial data in the form of financial statements. With compilations, there's no assurance provided. We're simply taking financial data prepared by the client and putting that information in a financial statement format. We're not required to verify the accuracy or completeness of the information provided. However, with compilation engagements, we're still going to want to gain an understanding of the entity's business and the industry that they operate in. Compilation procedures include collecting financial data such as the trial balance, general ledger details, and other financial records as necessary. We'll prepare and format the financial statements in accordance with generally accepted accounting principles, and we'll also ensure that the financial statements include the necessary disclosures if we're engaged to do so. The compilation report is similar to a review in that no opinion is expressed. The one change is that no assurance is provided with compilation engagements. So when is a compilation report necessary? It could be used by startup companies that need to show a set of financial statements to a potential investor. Additionally, small nonprofits could also use compiled financial statements to present to a board of directors or a potential donor if they don't have any audit or review requirements. And it can also be required by a bank or another type of lender, again, just depending on the amount of money that's being lent to the entity. And here again, I have some benefits and limitations of a compilation engagement. So a compilation is going to be more cost effective, especially when compared to an audit or review. They're simple, we're just compiling data in a financial statement form without testing or verifying any of the data. And then compliance. So a compilation could help an entity with financial reporting requirements, with a financial reporting requirement, without having to go through an audit or review. Some of the limitations include no assurance on the accuracy or completeness of the information. We're relying completely on management without any type of verification of the data. And there's limited usefulness because, again, it just provides no assurance. With that, I've gone through audits, reviews, and compilations. Now I'm going to go ahead and turn it over to Matt, who's going to discuss preparing audit-ready financial statements.
Thanks, Patrick. My name is Matthew Saucier, and I'm also an audit manager here at Rivera Gordimer & Company. As Patrick mentioned, I will be going over how to produce audit-ready financial statements. Specifically, I'll be focusing on the balance sheet and common areas on the balance sheet. It may not be all-encompassing for every business, but it'll be a great start to preparing for your audit. So the objective of a balance sheet reconciliation is that it's a crucial process in ensuring the accuracy of an organization's financial statements. The reconciliation entails going line by line down the balance sheet and comparing two sets of records. One set of records is your internal financial statements, and the second set is external documents which your financial statements need to agree with. Agreeing with external sources is key to accurate and complete financial statements. Agreeing with those sources gives you the ability to analyze and investigate discrepancies and major changes in a timely manner to avoid bigger issues down the road. It is important to have a consistent and routine process to ensure all reported numbers are comparable from period to period. This slide, I made a little Venn diagram on how a balance sheet reconciliation ties into these three important concepts of financial reporting. I'll start with the most important one, and that's accuracy. This is ensuring that all transactions are accurately recorded regarding both the amount and the classification. For any organization to be successful, they need accurate and reliable numbers. That leads into compliance. Some industries are highly regulated, and organizations need accurate numbers to ensure they are meeting all their compliance requirements. This can also play into financing. Most financing agreements will have financial metrics needed to maintain the financing relationship. If your record keeping and numbers are not fully accurate, it can lead to headaches with you and your lender and may cause big issues down the road. If an organization has accurate numbers and is compliant with all their obligations, they are now able to make insightful and strategic decisions on their future. Having a documented, reputable process that results in accurate reporting guarantees consistency, which allows you to look back, compare performances, and make future projections and decisions. All right, I'm going to start at the top of the balance sheet, and that's with your bank and investment accounts. Reconciling bank accounts entails reviewing those transactions that are shown in the accounting system but haven't shown up in the bank statements. And those are going to be outstanding checks and deposits in transit. You also need to look at transactions that are hitting your bank account but you may not have recorded in your accounting system. For example, your bank may charge you service fees or bounce check fees, things of that nature. You should be able to start your reconciliation with your bank balance and work back to the balance in your accounting system. You will add and subtract all the necessary transactions. It is important to do this monthly to ensure your financials are accurate and complete, and that you have a good handle on your cash balances and your expenses. Once you've done the bank reconciliation, you want to take that document and scan it for any old or larger items that may be unusual. If you have an outstanding check that is a few months or even a few years old, you may want to investigate what's going on. Also, you can identify errors such as incorrect posting, missed transactions, allowing for timely corrections. Now I'll move on. Investment accounts have less volume and they're a little easier to reconcile. First, I personally would start with reviewing your purchases and sales. Are these purchases and sales showing up in the way that you expect? Timing is key with how fast financial markets can move. Most likely you're paying a money manager, so you want to see that these transactions are happening timely and in accordance with your expectations. Next, I would evaluate your gains and losses on these investments. Are the gains and losses within your risk tolerance, and do they align with your company's goals? Should you consider switching investment types, maybe from bonds to equities, or maybe vice versa? Your return on these investments could influence business decisions. Do you have extra cash on hand you'd like to put to work for you? Or on the flip side, if you are anticipating a cash flow slump, should you draw on a line of credit, or would it be cheaper to sell off some underperforming investments and use that cash? Compare the return on these investments with your interest rates from the bank, especially in today's economy with higher rates than we've been used to in the past. You also really want to evaluate your capital needs. If your investments are savings for capital improvements or an expansion of operations, are they on track to meet your needs? Real estate prices, cost of capital, and construction expenses have all significantly increased. On the flip side, if you are anticipating a dip in cash flow, are your investments liquid enough to get the cash you need when you need it? And lastly, I'll mention if you're a nonprofit, you may have restricted investments, so you want to make sure that these investments are in accordance with your donors' wishes. Next is a very important area, and that's accounts receivable. You want to match your receivables to your ledger. You want to make sure that the amount recorded in your receivable ledger agrees with the amount in your uncollected invoices. This will eliminate confusion when collecting payments and avoid awkward conversations with your customers. To do this, you want to review your cash collection registers. You want to make sure your collections are being recorded properly and that the AR is being accurately removed. This will avoid overstating of AR, which could lead to incorrect cash flow projections, making it hard to make decisions. Partial payments kinda tend to cause some issues. If you commonly see mistakes, randomly select a couple transactions each month and walk them through the process from receipt of payment to recording in the accounting system to see where your errors are occurring. After you're happy with the balance, you want to review your aging buckets. It is crucial to review the aging buckets of your receivables. This will help you identify your customers who you need to collect from, and you may decide that you ultimately don't want to do business with customers who are always 60, 90 days or older. This will help you make accurate estimates of your allowance and your collections. Speaking of allowances, new in 2023 was ASU 2016, the Current Expected Credit Loss Model, abbreviated as CECL. This new standard requires you to make your allowance estimates based on the entire life of the receivable. You're required to use historical data to predict your loss estimates, as well as current economic conditions, customer creditworthiness, and any other supportable forecasts you use to produce the allowance amount. The long and short of it is you have to be proactive now about the allowance and anticipate your allowance at the birth of the receivable rather than when it becomes deemed uncollectible. This ultimately will lead to a more accurate balance at the end of your year. Next is inventory. Inventory can get complicated fast, so you want to evaluate your monthly purchases and your sales. If you are confident in your inventory system, Doing a quick calculation of your purchases and sales for the period, you should be able to back into your inventory balance, or at least be pretty close. This can play a big role in your cost of goods sold and your margins, so you definitely want to be on top of that. Reconciling reports to items on hand. If your company does not have a lot of inventory, this can be relatively easy. However, some organizations have a lot of inventory, and doing this monthly just isn't feasible. In that case, consider picking different portions of your inventory monthly, and this will help you identify areas that may need more attention. If you have substantial inventory, chances are your auditor is going to pick a sample and count it anyway. Doing it periodically may help with the end of the year crunch, as nobody wants to be counting inventory around the holidays. Your company should have a policy in place for their method of inventory. Ensure that that is operating as intended. There are multiple different options, and these can result in vastly different results. They're LIFO, FIFO, just in time, and there's a couple others out there as well. And then lastly, you want to write off any unused, damaged, or soiled items. Go down the inventory listing and make sure that these are all removed. This will avoid big write-offs at year end that can skew your anticipated profit numbers. Next is a relatively simple section for once, prepaid expenses. Prepaid expenses is the process of capitalizing portions of large expenses and matching them with the appropriate accounting periods. Just because you spent a large amount of money doesn't mean the whole expense needs to be taken that period. If you are 3 months into an insurance policy and it's December, you don't need to take the whole expense that year. Have the remaining amount on the balance sheet and flush it through the P&L in the next period. This will help you smooth out earnings and match expenses to the appropriate period. The best approach to accurate prepaid expenses is to take the amounts directly from your source document. So in my example of insurance, you want to pull that insurance policy and then create an internal spreadsheet that calculates the monthly expense as well as the remaining prepaid balance. Make sure your balance sheet agrees to the spreadsheet monthly. That way your expenses for that month are accurate. Other common prepaid expenses include rent and subscriptions. Property, plant, and equipment is our next area. Again, can be simple, but also complicated. First, you want to maintain a depreciation schedule. And this will calculate current depreciation and provide you with a monthly amount to book. If you don't want to maintain your own depreciation schedule, that's fine. I would encourage you to book at least a monthly estimate so you have a good idea of where you are. But if you do have a depreciation schedule, as the years go by, this schedule can get kind of large and you want to stay organized. So we recommend going down the schedule and removing fully depreciated assets. It will not have an effect on net income and can help keep your schedule readable and efficient. A capitalization threshold is also recommended, and that's the amount in which purchases above will be capitalized and anything below will be expensed. This provides efficiency for decision making on if a purchase should be capitalized or not. Recording additions is typically pretty straightforward. What you do is you book the cost of the asset and any significant expenses paid to put that asset in service. Again, this is an audit. We're all about source documents, so you want to actually have those purchase agreements, those invoices for things you're capitalizing to vouch back to. Recording disposals can be a little more tricky, and we see a lot of clients make errors in this area. When an asset is disposed of, you need to remove it from your ledger, including the depreciation that has been recorded, as well as potentially post a gain or loss. If the asset has no book value and no proceeds were received on the disposal, there is no gain or loss. If there is a net book value and proceeds are in excess of that value, you'll need to record a gain. If there is a net book value and the proceeds are less or none, then you need to record a loss. As I mentioned, we see a lot of errors here. For example, one may record a gain for the whole amount received without removing the asset. Or maybe they credit the asset account for the amount received in a sale and don't remove any depreciation. And then they have an inaccurate balance for the asset depreciation as well as the gain or loss. If you trust us, we've seen it all. So I wanted to go through a quick journal entry. Here we have an asset that had a net book value of $100,000. And you can see that with the equipment balance I'm crediting of $1 million and the accumulated depreciation I'm debiting of $900,000. However, they received $200,000 in the sale, so I'm going to debit cash for that $200,000, and that leaves me with a credit, so a gain on sale of $100,000. Sounds easy in theory, but not always as easy in practice. So that wraps up our assets, and now I'm going to move on to our liability section. I'll start off with, usually the first couple lines, accounts payable and accrued expenses. For accounts payable, you want to review unpaid invoices and ensure vendors are being paid timely. To help with this, you want to put in place proper cutoff procedures to make sure expenses are recorded in the period when they're incurred. It's a good idea to wait a little while to make sure you receive all your invoices for that month. And you also want to review any significant cash payments in the subsequent month to make sure that they were classified correctly. Next, I'll jump into accrued expenses. The most common ones being salaries and taxes. Very similar to prepaid expenses, you want to use source documents to create spreadsheets that calculate the balance monthly. A very popular and common, not popular, a common prepaid expense is salaries, as well as taxes. An example of a source document here would be a payroll register for the cutoff pay period. If a pay period is half in one period and half in another, you're going to want to accrue those wages on your balance sheet. It's a simple calculation, and you want to make sure it agrees to your payroll register. A common mistake that we see here is not removing the accruals once they've been paid. If you notice your accrual balances are getting larger and larger each period, it may be time to review the transaction detail and see what's going on. That applies to your AP too. You can age your AP just like your AR, and you want to look at those old invoices to make sure you're on time with your vendors and everyone's happy. Next, another common area in the balance sheet is long-term debt. Long-term debt, again, is on the simpler side due to the low volume of transactions. These are usually monthly payments made to your lenders. First step I would do is if your lender provides you with a monthly statement, review them and compare the outstanding principal balance to your balance sheet. Your lender is always the best source of information. If monthly statements aren't readily available, ask your lender for or calculate your own amortization schedule and use that as a guide. Once you have your principal payments in order, the interest expense should take care of itself. Analytically compare your interest expense to the outstanding principal balances and check it for reasonableness. After that, bust open the financing agreement and look for any financial covenants you may have to be in compliance with. Go ahead and calculate those covenants yourself and make sure you are compliant. If you are not, it's best to be proactive and address any concerns with your lender as soon as possible. Consider reclassifying your current portion of long-term debt as well, and that'll give you a better idea of your cash flow for the next year, especially if you use financial ratios such as your current ratio to make decisions. The current portion is going to be your principal payments that you expect to make in the next 12 months. And last, but certainly not least, please be sure to keep all signed documents from your lender on hand and readily available for the life of the agreement. Next, I'll go into everyone's favorite topic the last few years, leases. With ASC 842 in full swing, it is important to touch on these. First, you want to make sure you have all necessary documents, just like your long-term debt agreements. And you need these documents to include the payment terms. A big pain point for leases is the interest rate. A lot of times your lease document will include the length of the lease, the monthly payment, but will not have the interest rate. There are a couple different options you can use to determine your interest rate, but I would suggest contacting your auditor in advance for guidance, or document the interest rate you used and how you got there. Next, you want to review those terms and determine the proper classification, whether that be an operating lease or a financing lease. Things to consider for financing leases are transfers of ownership, purchase options, the length of the lease term, and the present value of the lease payments. If you have significant leases, I would recommend purchasing a software to manage this, but you could also use a template that you can find either online or you can ask us. This Excel template will calculate the asset balance and liability balance for you. The asset is going to be referred to as the right of use asset, and the liability will be the lease liability. These balances are both the net present value of the future lease payments. Your monthly adjustments will then be amortizing the asset, think depreciation, as well as amortizing the lease liability, think like long-term debt. Be conscious of the classification, as financing leases have an interest expense portion in the monthly journal entry, while operating leases do not. If leases are extended or any other change in those terms, this could have an effect on the reported balances. Be sure to update your calculations when new terms are in place so that you have an all-encompassing net present value. Last on the balance sheet is the equity section. This can get complicated quick, or it can be very easy. The retained earnings balance on your current year trial balance should tie directly back to your prior year audited financials ending balance. While a variance here can sound daunting, it's usually one of three options, or potentially all three. Number one is there was a prior year adjusting entry booked by your auditor that was not booked in the accounting system. Second is transactions were booked to the prior year after sending your auditor the trial balance. And then third, transactions were incorrectly booked directly to retained earnings. Now that you have those options in place, define the balance sheet account that's throwing you off, go account by account, and reconcile the current year beginning balance to the prior year ending balance on the audited trial balance. This will spot your difference and allow you to figure out where you are and how and what is making you off. If it's the third option, that transactions were incorrectly booked directly to retained earnings, you may not be able to identify it that way. So you want to look at your general ledger detail of that retained earnings accounts for erroneous transactions and properly classify them out of retained earnings. If you are unsure of where to stick them, please ask your auditor. It will save them time and in turn you money to address this on the front end. Some other common equity areas are things like common stock and treasury stock. These typically don't change a lot year to year, so you should have good records on these balances and be able to easily maintain changes. And last is every business owner's favorite, distributions. Things to consider for distributions are determine if you would like to close out the balance every year against retained earnings, or if you like to keep the gross number rolling forward year after year. If you want to close it out every year, make sure your beginning balance is 0. Also, if you are an S Corp, make sure that the distributions are pro rata based off ownership percentage, especially if there were changes in ownership percentage during the year. If there were, I highly recommend go ahead and gather those documents and ensure they're signed and ready to go. Now that I've gone down the whole balance sheet, long story short, no matter what the account is, I think there's 6 easy steps that you should follow. Gather all necessary documents, including statements, invoices, receipts, and internal records. Next, you want to compare those balances. Match the balances on the balance sheet with the corresponding necessary records. Third, you want to identify and investigate discrepancies. Look for differences between recorded and actual balances. Determine the cause of any discrepancies by reviewing transaction details and supporting documents. 4, you want to make adjusting entries. Make all necessary adjustments to correct those discrepancies. 5th is review. After you make an adjustment, you want to make sure the result is what you expected in terms of completeness and accuracy. And number 6, lastly, is document this process. You're going to want to do this monthly. You're going to want to go on vacation, and you want to make sure that other people can step in and do this for you to maintain consistent financial reporting. Once you've done those 6 steps, I got some common issues that we always find. The first is timing differences. Adjust for timing differences by noting the appropriate period which the transaction occurred and where it should be reported. This includes items like outstanding checks, deposits in transit, and invoices received after the period end. You want to make sure there's no errors in recording and correct any data entry errors or accounting mistakes. Some examples of data entry errors can be transposing numbers, double posting transactions, or posting just incorrect amounts. 3, you want to make sure there's no missing transactions. Identify and record all omitted transactions. Examples here can be depreciation entries, accruals, bank service charges, or adjustments of prepaids. And 4, complex transactions. These are transactions that are not straightforward, and some of these examples can be intercompany amounts, deferred revenue, and accrued expenses. You want to make sure you have a good calculation method to rely on your results. And why does all this matter? Well, in the realm of financial reporting, precision and transparency are most important, and reconciling these accounts can fortify your financial reporting process, minimizing the risk of material misstatement. It will also increase your transparency, decision making, integrity, and overall just confidence in your numbers and your business. Auditors may uncover discrepancies during the audit process, requiring adjustments that could have been easily avoided with a routine reconciliation. This saves us time and, again, you money. That's it for my balance sheet reconciliation. Thanks for listening. If you're still listening, I'm sure you will enjoy next week's presentation on July 24th at 9 a.m. as Brooke Dawson and Sam Lazara present on the Form 990 highlights and how watchdog agencies utilize them.